Good morning, everyone. And this is Sujata from Happy Investor. I invite you and welcome you to our Saturday webinar, this 19th of October, 10 a.m. And hope you've all been having a good festive season. And we wish you a very festive season ahead. So today we are here with an interesting topic, not something that everybody will share with you the nitty-gritties. So we are here with something that's out of the normal area of information that an investment advisor would share with you. So welcome to our Saturday webinar on term insurance. We shall have a 15-minute presentation where we talk to you about the 6 key things that you must know with respect to term insurance. And after that, we shall be able to take some questions. And I shall now start with the presentation. So here we are with our Saturday presentation on an interesting topic, which is 6 key things that you must know when it comes to term insurance. Basically, term insurance is to secure your family's future. So when we talk of insurance, you basically have 2 types of insurance. One is life and one is general. What comes under the general category is your regular other insurances like health, a vehicle insurance, property insurance, or a fire insurance, things like that. On the other side is life insurance. Now, under life insurance, there are many categories too. You get options of an endowment policy, where you get money back at the end of the term of the policy. So you hold it for 20 years, and at 20 years, when it matures, you get the money back. A whole life, basically, this covers you as long as you're alive. So it's like till age 100. It covers you till the age that you're there. When you pass away, your nominee gets the money. Then you have a money back policy, which pays you back a certain fixed amount or a certain fixed percentage of the cover in intermittent years of, say, 5 years or 6 years or 7 years. After all of this comes the term insurance concept. This is what we will be focusing on today. So why term insurance? Who needs term insurance? Term insurance is basically cover that's taken for the main earner, the family, who provides for the other dependents within the family. Why? Well, this is basically to protect your family when they depend on your income. So if your income is how they are going to survive, then you need to be protected so that their future is safe. And when do you start with the term life insurance? You start as soon as someone is dependent on you for the income that you earn. So term insurance is crucial for protecting your loved ones. How does this work? As soon as someone in your family becomes financially dependent on you, then your income is what they will need to take care of their financial requirements or their needs. So whenever you have someone who's dependent on you, whether it's your spouse, whether it's your children, or whether it's your parents, you need to ensure that their financial security is safe if something were to happen to you. So term insurance basically steps in to replace the lost income and cover essential expenses for the family, at least till the time that they are able to be financially independent themselves. They are younger ones. And as long as they are there, if they are your parents. So how much do you really need as a cover? The thumb rule is that when you take term insurance, it should be about 15 to 20 times your annual income. Logic there is at least you should be able to spend, or you should be able to provide for the next 20 years at the current cost of living. What is the consideration for this amount? You need to look at future expenses for the family, any specific goals for like an education or a house, and then any other loans that you already have which need to be paid. What's the logic of this thumb rule and this consideration? Well, the ideal consideration should be about 15 to 20 times your current annual income, but it should also consider any kind of future expenses like a children's education, a wedding, or outstanding loans. Because by making sure you have all these in that, your term insurance covers all this so that your family will then be financially secure in the event that your income ceases or in your absence. So how does this really work? You take a policy and you pay a premium for a set number of years, say 10 years, 20 years, or 30 years, depending on the comfort level that you have in terms of how the payout works. It is a death benefit. Your family receives the benefit if you pass away during the period of the policy. And it also represents the human life value because we've taken into account future income, future expenses, and any liabilities that you would have, which would have been paid out from your future income. So term insurance is very simple. You pay premium for a set period. If something happens to you during that term, your family gets the lump sum amount. There is no payout if you survive the policy term. If you die and your family is paid out that amount, this lump sum is usually calculated based on the value that your life has for your family. It takes into account your future income, expenses, and liabilities, and it's pure protection. If you outlive the term, there's no payout. And the goal of a term life policy is to secure your family's future during your working years so that they can be independent as soon as the finances that you have provided over there are enough for them to take care of themselves before they get independent themselves. So why is a term benefit a better term insurance a better choice among all other life insurances? Term insurance gives you a higher cover at a lower cost. It is flexible. It can be tailored to your situation. You want to pay annual premium. Yes, you want to pay premium only for a set number of years. Yes, you want to cover for an X amount. Yes, all that is done as per your requirement. It's purely protection. It's not an investment. So there is no payout if you survive the term. The payout is only if you die or death happens within the term of the policy. So compared to traditional policies, which we spoke about right at the start, which is endowment or money back or whole life policies, term insurances are more affordable because the payout happens only on death. There is no payout at the end of the term. So this gives you a higher cover at a lower premium. And it also gives you the flexibility because you're paying a lower premium, which you would have otherwise been higher for an investment connected insurance. The remaining amount, it gives you the flexibility to invest that saved amount elsewhere to generate better returns. Basically, if you were to pay 100 rupees as a premium for an endowment policy, you might pay just 20 rupees for a term cover, the same value. So since you're paying only 20 here and you're getting a higher cover, the remaining 80 rupees can be invested in a product which would give you much more returns for the same number of years. So this ensures that you have secured the financial future as well as you're also generating wealth through that investment, which is going to give you better returns. So when we do term insurance, we don't mix insurance with investments. So there are some misconceptions, common misconceptions about insurance, which all of us have gone through. Myth is that life insurance is a long-term investment. I start when I'm young, I continue investing for the next 20 years or 30 years, and I get a lump sum amount at the end of it. What's the reality? Reality is that life insurance actually should be a primary risk protection. It should not be an investment. The myth is that life insurance is the best tax saving option. It is not to be looked at as a tax saving option because if that is your goal, there are better alternatives for tax saving. So the common mistake people do is treating life insurance as an investment product. And endowment and money back policies offer you returns, but the returns are very low for the time period that you invest. And they also come at the cost of inadequate coverage in terms of term insurance. So if you're covered just for 20 lakhs, that's not a good enough cover for your family's future. It could be, you might think today 20 lakhs is huge, but 20 years down the line, 20 lakhs is not going to be that kind of purchasing power. So term insurance focuses purely on a higher protection at a lower cost. And as for tax saving and insurance benefits, tax saving benefits that insurance offers, there are better tax saving instruments that are available. How do we choose the right policy? You need to choose the right coverage amount, which is based on your income, your liabilities, and your family's future needs. The term of the policy has to align with your life goals. And typically, because this is a risk cover for loss of income, it is taken up until the normal working age of 60. You can also choose additional riders like accidental death coverage, which gives you a double benefit kind of additional cover and added security. So you have to choose the right term policy, and that needs a fair amount of planning. The amount of cover should be able to cover all your financial responsibilities, and it should last till your children can be on their own. And you can always consider adding riders for added protection. And what's the Happy Investor promise here? We will advise you personalized advice to suit your particular needs. We will handle all the documentation. So it's a very simplified process for you. We will have ongoing assistance and support for you in the form of reminders for premiums and evaluating whether you are adequately covered, or because of life-changing situations, do we need to increase your cover? All that guidance will also come from us. We have a set of questions that people generally ask about insurance. I shall take you through that. These could possibly answer some of the questions you have in mind. And after that, we could take questions from you. So how long should my term insurance policy be? Typically, like we said, your policy should cover you until your age of 60, because that's the normal working age. Or when you feel that, okay, now I'm going to retire because I have created the amount of corpus that I need, you could then choose to close your policy. But typically, while taking the policy, it's usually taken till the age of 60. Because when you take a term cover, your premium is fixed for the term of the policy. So whether you take it at 25 or you take it at 30 or you take it at 35, at whatever age you take it, until what age you've taken it, it's a contract. So your premium doesn't change once you start paying. And that's why we fix it till 60. You can choose to stop paying as soon as you feel that, okay, I've created the money that I need. Can I increase my cover later stage? Yes. There are two ways. You can add an additional policy, or if two policies are going to become more expensive, then we could take a new policy for a higher amount and then close out the earlier policy. What happens if I outlive my term policy? Well, it's a term policy, it's a pure risk policy. So if there is no payout if you outlive the term, it's not an investment. It is protection for your family for the loss of income. What riders can I add to my term insurance to make it more comprehensive? But typically, there are one or two. One is a critical illness cover, or which may or may not be the right one, because a critical illness cover can be taken separately. But yes, an accidental death benefit adds more value to your policy, as it typically pays out a higher amount in case of death due to accident. Is term insurance tax deductible? Yes. The premiums paid for a term insurance are eligible for tax deductions under Section Section 83. And the death benefit that your family receives is also tax-free, but it should not be product that you take for the purpose of tax saving. Can NRIs purchase term insurance in India? Yes, NRIs can purchase term insurance in India. They just need to provide complete documentation as is necessary, and in some cases may be requested to undergo a medical test depending on the health declaration that the person gives. The only condition is that while taking the policy at the start, you need to be present in India when the documentation and the policy is being issued. After that, you could be residing anywhere in the world and still your policy would be valid. So these are some of the typical questions that people would have, which we've shared with you. I would now be open to any kind of questions that our audience would like to ask today. You could type in the question in the chat box and we'll be happy to take it. Have we been able to clear certain misconceptions with you about insurance today? And if we have, then we are really happy to have done that. And if there are any requirements on insurance from your end, you could always get in touch with us. You could call us on our numbers as shared here, 99004-45210. That's Deepesh's number, and 96200-96201. You can reach out to me on that number. You could also email us at info@happyinvestor.in for any of your queries related to insurance, and we would be happy to answer them. Yeah, Santosh has a question. He says, is amount 20 times of the annual package? Yes, that's a broad thumb rule. Specifically, how much you can actually take would depend on various elements. We need to know your annual package. We need to know your annual package. We need to know your future expenses and commitments, your future requirements. For example, if you have children whose education is still to be done, if you are planning for certain wedding expenses for your children, or you have a home loan, or you plan to take in a home loan couple of years down the line, or you already have certain existing policies which cover you for a certain amount, we need to look into all of this. Your education also matters. We have to put in all these metrics before we can arrive at a number that you will be eligible for. But 15 to 20 times your current annual package is the broad guideline. I hope that answers Santosha's question as well as Deepak K.S. We thank all our clients who logged in. We thank all our visitors who were online on YouTube with us. And soon we shall share this PPT for your benefit. And for those who are still logged in, you can always reach out to us. You could always share our numbers with your contacts and ask them to get in touch with us for their insurance needs. We would be happy to help them. Thanks for joining us. Thank you. Have a good weekend.